separate things. One is just looking at the interest rate environment, which is clearly we're kind of at a change, or as they would say in markets, a pivot in the cycle, where we're about to embark on an easing cycle. Secondly, I want to have a look at the Irish economy in broad terms, and then finally have a look at some of the specific issues with the Irish housing market. So the first chart, just looking at the inflation picture, and clearly we had a very unusual, I mentioned the word cycle, but a very unusual economic cycle for the last 4 or 5 years, really. We had COVID, big lockdowns, we had then a rapid rebound, which I think was much more rapid than people envisaged, and a series of economic shocks, and consequently inflation took off at a pace, I think, which surprised everybody, not least central banks, which were a little bit slow initially to respond. And as you can see from the chart, inflation went to levels last seen really back in the 1970s at times. So, but now we've got inflation falling everywhere, and it's down 2.2% in the Eurozone, 2.2% in the UK, 2.5% in the United States. So the three main central banks that we would look at, they're all much more comfortable now that inflation is back around their target. With one caveat, and that is the main reason inflation has fallen is because energy prices, the base effects from energy prices falling out of the annual change, and goods price inflation in most countries, including here, is now around zero. So what's driving inflation still is services. Particularly a lot of people, or a lot of us, are still spending a lot on what you might call fun services, like holidays. So holidays, airfares, hotels, restaurants, they're the things that have been driving inflation. But anyway, central banks are more comfortable. Maybe issues with wage inflation for the ECB, particularly in the Bank of England. But clearly, the cycle has changed there. And what's interesting in that respect is that you've had a change in particularly rhetoric from the American Central Bank, and to some degree from the ECB. The American Central Bank has, unusual, it has two mandates: stable prices, which they take to be 2% inflation, and full employment. So in the United States, what's happened in the last year is the unemployment rate has started to tick up. So if you look at the GDP figures, they're still showing 2.5% growth. But if you look at the unemployment figure, it's gone from, say, 3.5% low to 4.2%. And there is some of you may have heard of it, it's called the SAM rule, S-A-H-M. It's after a female economist called Claudia Sam, who first brought it out a few years ago. What she said was that if you look at previous cycles, if the unemployment rate goes up by 0.5%, then that is usually the sign that we're in the start of a recession. Now that rule, if you like, has been triggered in America, and it's quite interesting that particularly Powell, the central bank governor, as you see here, in August, he made it quite clear that the Fed are now shifting their priority, if you like, from they're kind of happy that inflation is coming down, so they've shifted to concern about unemployment. Now, as I said, if you looked at the GDP data in the States, you'd think, there's no obvious sign of a recession. Having said which, of course, if you look at the bond market, the yield curve has been inverted, was inverted for about 2 years, which is normally a financial market sign that they think a recession is due. The yield curve is now started to go in a more normal direction upwards. So central banks, particularly I think in the States, and just to a lesser degree, but just still there, I think, in Europe, beginning to be concerned that maybe they kept rates too high for too long. You know, and if you look what happened to rates, if you look, for example, in the Eurozone, we were at minus 0.5%. And I think in time when the history of the world is written, I think they may consider that maybe wasn't a good idea. It seemed a good idea at the time, perhaps, but it created a lot of issues. So interest rates in the Eurozone went up by 450 basis points in a relatively short period of time. And as you see from the chart there, in both the United States and the UK, interest rates went to 5%, or in the United States, 5.25% to 5.5%. So very rapid monetary tightening, because central banks felt they got behind the cycle. They initially thought inflation would be, the word used often was transitory. There was a series of supply shocks which would disappear, but obviously that didn't quite work out as they thought. So consequently, we're in an easing cycle. So interesting enough, I suppose the ECB was very slow to raise rates, but has been the first to cut. So we've had two 25 basis point cuts in interest rates. Last night, the Fed cut interest rates by 50 basis points, which is telling you itself that they maybe think now they got, as they say in financial markets, they got slightly behind the curve. But it does tell you they're a bit more concerned about the real economy now and less concerned about inflation. It's interesting also when the Fed produced their forecasts, all of the regional governors produce forecasts. So this is produced in what's called a dot plot, which tells you where they think the economy is going to be over the next few years, but also where interest rates are going to be. So if you looked at the dot plot last night, the median expectation is for another 50 basis points this year, right? So there's two more meetings. So there's not long to go to the end of the year. So that's another 50. So that would be 1% cut if it materializes. And then for next year, at the end of 25, there's another 1%. So they are really now projecting quite a rapid fall in interest rates in the States. And if you look on the table there, you can see it. Everywhere people are, the market is just pricing in now fairly steady monetary easing. Expectations about interest rates in the market don't tend to be a good predictor, actually, and they're very volatile. But right now, anyway, it seems pretty clear that we're in line for fairly steady rate reductions, absent some shock to, for example, to oil prices or something like that, which is always possible, of course, given the international environment. But also, I think what's worth noting is that nobody, or rather the markets, are not predicting that we're going to go back to extremely low interest rates. So as you can see there, where are we going to get to? It's a kind of a more normal environment, if you like, rather than what we've seen over the last decade. So that would change, of course, if suddenly there was an idea we would be into a much deeper downturn. But at the moment, that isn't the case. And the corollary, I think, as well, is that longer-term interest rates, like 10-year bond yields, I think are unlikely to drop dramatically either. So, for example, if you look at 10-year interest rates in the States, 10-year bond yields, are they likely to come down to, say, 2.5%, 3%? I would think that's very unlikely, particularly given the fiscal outlook. I mean, we don't know what's going to happen in terms of the election in the States, but both candidates. It's hard sometimes. They can say they can do a lot of things, but they have to get it through Congress. But nobody in America thinks that there's going to be a massive fiscal tightening. and it's very difficult in Europe to have a significant fiscal tightening given the politics. So there's going to be a lot of bond supply, so consequently I think longer term interest rates are going to stay relatively high, or if you like, maybe more normal from what we, if people remember back before the last decade, much more normal levels perhaps. Just as a point to illustrate a specific thing that does in fact impact Ireland specifically, and that is during the noughties particularly, there was a huge amount of lending at variable rates in banks, and with the interest rate linked to the ECB's refinance rate, and so they're called tracker rates here, of course. And the number of people with tracker rates has actually fallen quite significantly over the years, because obviously they've paid them back, mortgages have matured, redeemed, and now most of the Irish mortgage market is actually fixed. But there's an interesting change the ECB made in September. They pre-announced it about 6 months ago. But just to illustrate it on the chart, basically there's 3 interest rates the ECB uses to influence market rates, 2 of which are more important. One is historically the most important, which is the refinance rate. So banks can borrow money from the ECB for 1 week at the refinance rate. And historically, banks have got to keep reserves at the ECB. ECB kept reserves very scarce, so you had to borrow to top up your reserves, so the interest rate you had to pay, the refinance rate, was the key market rate. Hence the rise of tracker rates, as I said, in the noughties particularly. For the last 10 years, more or less, the ECB has been flooding the market with liquidity. So there's massive excess liquidity in the market. So what became the important rate was the rate at which the ECB itself would pay for deposits. And so if you like, it's a corridor. The ceiling is the refinance rate, the floor is the deposit rate. So the deposit rate became the key variable of the last 7 or 8 years. And the spread between them was 50 basis points. But what's going to happen now is the ECB is gradually withdrawing the excess liquidity. And as that happens, the interest rates will possibly move slightly above the floor. But they want the ceiling to be much narrower than before, so they've consequently reduced the spread between the refinance rate and deposit rate to only 15 basis points, which is why if you do have a tracker rate, you've got a bigger cut than others would have received when they changed the deposit rate last week. Let's move on then to the Irish economy. And there's an awful lot of, if you follow it, you'll know a lot of debate about, GDP isn't the right variable to measure Irish economic activity, and people have come up with different ones. The one that quite often is trotted out is called, is looking at domestic demand, and it's modified to exclude some multinational stuff. But the problem with domestic demand as a measure, it's domestic demand. So it's consumer spending, government spending, and construction and business spending on machinery and equipment. But that doesn't, so it excludes all exports, which is, so therefore that's not very meaningful. And of course, if all domestic demand was met by imports, it would have no impact on the domestic economy either. So it's not a very sensible measure in my mind. GDP is the international measure still. But what's an unambiguous real variable, which is, I think, crucial for a lot of things, taxation, spending, but also crucial for the housing market, is employment. And it's a real variable, and as most people would know from our history of independence, our main economic problem was we had mass unemployment. And for the last a long time now, we have full employment. In fact, even everyone takes it for granted, it's not a political issue, nor even mentions it anymore. The unemployment rate's down at 4.5% for a long time now. Labour is scarce. So it's employment growth that I think is key in our economy. It's an unambiguous real variable. If you think about what happens in our economy, if employment rises by 3% and wages rise by 4 or 5%, that's an 8% rise in household income. That's the key driver of a lot of housing demand. It's a key driver of tax receipts, the key driver of spending. So as long as employment continues to grow, it's very difficult to see any negative impact in terms of demand for housing. Just on the chart, you probably aren't aware of it. If you look at GDP, it has fallen very sharply in the last 18 months, significantly negative. The reason for that is because multinational exports, particularly pharma, boomed during, paradoxically enough, boomed during COVID. So we didn't have our economy grew at 5 or 6% in 2020, where everybody else's contracted. So that was largely due to pharma exports. Obviously, as the demand for those vaccines slowed, then that's the big driver of the contraction in GDP last year. But what's happening now is two things. One is that pharma exports are rebounding very strongly, but the other thing is that there's a massive increase in Irish service exports, particularly computer services and software. So as most people know, we have a lot of what used to be called the FANGs here. And I think Ireland is now almost becoming like an AI stock, because what's driving a lot of the exports now are the companies that are deemed to be the main beneficiaries of this whole AI boom. And you can certainly see Irish service exports are rising at like 20% a year. The corollary with this, very strong employment growth, very strong economy, has been, of course, a massive change on the fiscal side. So Ireland is one of only 2 countries last year in Europe that had a fiscal surplus. Most people most countries in Europe are running quite large fiscal deficits and are struggling to bring them under control. In our case, we're running very large fiscal surpluses. What I'm trying to do on this chart is to, some of the commentary on the fiscal side I think is quite misleading. The key thing on the fiscal side to grasp is that you can divide the budget into 2: current spending and capital spending. And the main argument usually is that if you spend on capital, you're creating an asset, and therefore, return on that asset in time, and also you're boosting the supply potential of the economy. So Ireland, as the blue bars there, Ireland is running very large current budget surpluses, like 15, 16 billion. In other words, current spending is 16 billion below current revenue. And that includes, by the way, spending includes about 4 billion on debt interest. So if you take that out of it, there's a very large surplus there. And so what do you do with the surplus? So Ireland obviously has decided, or the authorities have decided, we need a lot of capital spending. So consequently, we have, as you can see there, the green bar, quite a large capital deficit, maybe 12 billion. That still leaves you with quite a big surplus. So what do you do with it? And the answer is, well, we could, I mean, conceptually, you could run down the debt much more rapidly, but our debt ratio in terms of GDP, which is the one that matters for EU rules, is 40%, which is one of the lowest now in the EU. Our 10-year bond yield is 2.5%. That's 40 basis points over Germany. France is about 70 basis points over Germany. Ireland is one of the lowest interest rates, long-term interest rates in the Eurozone as well. So sometimes you'll see people saying about Ireland's debt and dividing the debt by the, that's all nonsense. The market thinks what matters if for a government is, can you roll over your debt? And at the moment we can roll over it very easily. The average interest rate of the debt, by the way, is 1.5%. So for years, if you issue bonds at zero interest rates or very near it, then obviously over time that impacts the debt. So a lot of debt is rolling off now at coupons that were issued 20 years ago. So if you I'm sure I'm speaking to inverted a lot here, but if you're rolling over debt and the coupon was 4%, and you're retiring that and are replacing it with 1 to 2.5%, the debt interest bill is not going up. The finance minister here a few years ago was saying, oh, it's going to rise. That's not true. In time it will, of course, as we get to the lower interest rate rolling off, but not now. So go back to the point. So what you do with your, you're still running a budget surplus. So what the authorities have done, of course, is they've set up two what you might call wealth funds to get round the kind of paradox, really, that is when the exchequer has loads of money and the economy's doing well and you're at full employment, it's very expensive to build anything. When there's mass unemployment and resources are available and it's much cheaper to build, you haven't got any money to pay for it. So the idea is you set up this fund, which you can, the two funds, one you can dip in for pensions, in 30 years' time. The other, a more short-term infrastructure and climate fund, which you could use if there's a downturn in the economy. So that's the orange bars. So that's what they're going to do. And obviously, on top of that, now we've got the Apple 14 billion. So one option would be if you divide 14 billion by 5.3 million, we'd all get a check for 2,000, whatever, 800, which I don't think they're likely to do. I think they're more likely to just put it into the Future Ireland Fund. Just as an aside as well, I thought some of the commentary on that is bonkers. By the way, like that Apple case goes back in some cases to the late 90s. So the idea, and the tax code has changed so massively. So the idea that something happened then would have a massive negative impact on any FBI now, I just think that's completely implausible. In terms of inflation in Ireland, there's a bit of concern about, could the economy overheat? And historically, it's difficult for Ireland to overheat through excess demand simply because we import so much. So when spending goes up, it tends to leak into imports rather than push up prices. This is the inflation figure for Ireland, also the Eurozone average. And Irish inflation, this is called the HICP measure, which is the one they use to compare across the EU. The Irish measure is 1.1%. The EU average is 2.2. So Ireland's inflation rate currently is half the EU average, and there's only one other country with low inflation. So why is inflation so low? Because goods prices are now zero. Goods price inflation is zero. So energy prices fell sharply, but also things like clothing and footwear, for example, are down 7% on last year. So there's a kind of global disinflationary impulse coming from China, and that's helping to push down the price of goods. So that isn't the problem for Ireland. The problem in Ireland and the EU, if you think it's a problem, is services inflation. Services inflation in the EU is 4%, 4.1%. Here it's 2%. Has come down quite sharply. So the main driver of inflation remains services, and in fact it's spending by you and I on things like package holidays, as I said, restaurants and airfares and so on. So at the moment anyway, there doesn't seem to be any obvious evidence that the economy is overheating in any way. So then coming to the housing market. So this is Irish, the CSO's retail residential property price index, the year-over-year change. And I think when you look at that chart, I think sometimes people are surprised because you kind of think, house prices have kind of just keep going up, which they have been doing for a long time, but they don't go up at the same pace every year. And so, for example, during the COVID, there was a slowdown, and also, of course, when interest rates started to go up, there was just a bit of a slowdown. But as you can see from that chart, prices did slow in 2023. Some people felt that some of the forecasts, I think, was that you'd get a fairly significant nominal house price fall. But that didn't happen. All that happened is instead of house prices rising at, say, 0.5, 0.6% a month, they started to rise at, say, 0.2, 0.3% a month. They're still going up, but at a much slower pace. Prices in Dublin, though, did fall on a monthly basis for a period. I think that's partly because, obviously, it's much higher interest, much higher mortgages in Dublin generally. Probably the higher rates had a bigger effect there. But also, as you can see from that chart, which doesn't include yesterday's figure, by the way, you've had a strong rebound in 2024, and you probably saw the figures yesterday. I actually thought the monthly figures were slowing quite noticeably. So the monthly increase was dropping to like 0.3, 0.2, and yet the last 2 months we've had in June 0.9 monthly rise, and in July 1.1%. So that's over 2% in 2 months. And in certain parts of the country, it's quite extraordinary figures. As in the Midwest, which in the CSO's language is Clare, Limerick, and Tipperary, house prices there have gone up 5% in the last 2 months, 7.5% in the last 3 months, and they're up 13.5% over the last 12 months. So certain parts of the country are still very strong. Dublin is Dublin city house prices are back over 11 or 12%. So the idea, the media kind of put in a story that a lot of people are, moving out to away from Dublin to some degree, helped by the fact that you can work more from home. To some degree, that's probably the case, but the other thing is there's very little housing built in Dublin, and a lot of housing is built outside of Dublin. And the supply there is, as it is much greater. So I think it's a bit overstated. Clearly, a lot of people still want to live in Dublin, and particularly Dublin City. And house prices there have gone up significantly because there's virtually no supply there of housing, of course. There's some apartments. I think rents are an interesting case as well, because I have a model that tries to model house prices and rents particularly seem to be driven in the model by particularly employment growth and therefore the housing stock per head. And you can see from that chart there's a significant downturn in rents, particularly in Dublin, during the lockdown. And I think that was because of the behaviour of a lot of the workers for the multinationals, particularly around the Docklands, the Googles and so forth, that a lot of them just simply left Dublin, went to live somewhere else when they could. When they came back, then we've had the recovery in rents. But rents are easing again. But what I've done on this chart is showed you two lines. One is a monthly figure, which the media don't bother talking about actually, but it's a monthly figure in the CSO, the CPI index. And every month the CSO do a survey around the country of what rents are that are actually being paid. So that's existing rents basically. And as you can see, existing rents, the rate of growth has slowed quite a lot and is now down to, that's a quarterly figure. The actual figure in July was 4%. So that's a national figure. But the other line, the orange line, is from daft.ie. And daft.ie is obviously it's a website obviously picking up asking rents for new lets. And so as you can see, there's quite a difference. And I think that's probably picking up rent controls. Because rent controls at the moment, in a lot of the rent control areas, you can only increase rents by 2%. Obviously that doesn't apply for new builds and new lets. So if you like, the difference, I think, does probably reflect some impact from the rent controls. The other thing, daft.ie are also showing that they have about, I think, 2,500 lets on their site, which is still around historical lows. If you go back 10 years, it would have been like over 20,000. So one of the kind of puzzles maybe is why didn't Irish house prices respond more to what was, a 450 basis point increase in ECB rates? And I think there's 4 or 5 reasons. One is, again, which it doesn't suit the media narrative to say this, but the pass-through from ECB rate rises to actual new mortgages was very small, unusually small. So the average new mortgage went up by, from trough to peak, about 175 basis points, which is a long way from 450 basis points. The reason for that was largely to do with the massive excess savings that built up in Ireland during COVID. You think about COVID and the lockdowns, a lot of professional people paid monthly, still receiving their salary, wasn't a big increase in unemployment. Suddenly though, you can still buy goods, but you can't buy a lot of your discretionary services that you would have bought in the past. So automatically there was a massive increase in savings, forced savings if you like. And that manifests itself in a massive increase in excess deposits in the banking system, which is still there. So the Irish banks, AIB, Permo, and Bank of Ireland, had massive excess deposits, which is still to have. They could absorb the ECB rate and market rate rises because they didn't have to go into the market to borrow money. The non-banks, which had taken market share the previous couple of years, they're very dependent on market rates. They kind of were knocked out of the market. They're beginning to come back now. Well, that was the main reason. So essentially, if you were a saver, you lost out. There's no incentive for any bank to raise savings rates. If you were a borrower, you gained, and if you were an equity shareholder, eventually you gained, even though it took a while for that to happen. The other reasons are central bank, oddly enough, you have the ECB raising interest rates, and you have the central bank easing credit at the same time. Just again as an aside, there's a huge amount of emphasis on debating fiscal policy. We have a budget coming up shortly, endless debate. The impact of the budget on most people's incomes is very small. What the central bank does can have a much bigger impact on credit, and yet there's virtually seems to be no political discussion about it at all. So the central bank raised the LTI limit from 3.5 to 4. That's had a huge impact on lending. If you look at the percentage of lending now above 3.5, it's much higher. Employment growth, crucial in my view for the housing market. You won't get a big housing downturn. You usually need two things. You need a big employment shock, and you need banks to be in a position where they can't lend. Now, neither of those are with us now. Banks are a lot stronger, and they were a huge amount more capital, much more profitable. Again, through the largesse of the ECB. The ECB was paying banks 4% on their deposits. Those deposits are enormous at the central bank, 90 billion. Multiply 90 billion by 4%, that's 3.6 billion that was been given, that AIB, Bank of Ireland and Permo were getting. Of course, on the other side, they're paying a bit on the deposit side, but that's one of the main reasons why bank profitability in Ireland is so high. And finally, of course, housing supply, which I'll come to in more detail in a minute. Housing supply has gone over 30,000 for the first time in 15 years. 15 years. Just looking at housing supply then in more detail, the orange line there is completions, and just look at that line after the crash. We were building less than 5,000 houses a year. Last year was 33,000. It's very difficult to know what this year's figure is going to be, because I noticed the Taoiseach said he thought it would be 40,000. I think the consensus may be 35. The reason I say that is because one of the main leading indicators is completions. Commencements, where a builder has to notify the local authority that they've commenced building. And there's a reasonable relationship between commencements and completions. Not precise, but reasonable, obviously you'd expect it to be. But what the government introduced was a waiver on development levies, which was initially going to expire at the end of April this year. So in the last couple of months before that expired, there was a massive notification of commencements. So if you took that figure, you'd say, well, housing supply is going to be like 45,000 this year. But most people think it was just distorted to get in before the end of the deadline. But more importantly, if you look at the blue bar, we have about 2.2 million, roughly 2.2 million houses, residential properties in Ireland. The population has been rising at one of the most rapid rates in Europe. So consequently, as the blue bar shows, if you simply take what now is 2.2 million and divide it by 5.3 million population, that gives you the 400 houses per 1,000 people, which has been falling, as you can see, steadily for a long, long time. And that is one of the key variables that feeds into a lot of predictions about house price inflation. as a supply variable, the housing stock per head. And the problem with housing in a way is that, as we all know, from a decision to build to completion is a long and risky process. Population can rise much more rapidly, much more quickly. So, for example, we just got the figures for, they produce estimates for population every year, usually around August, for April, because that's obviously the census month. So to April 24, population went up by 97,000, which is 1.9%. So clearly, last couple of years, we've seen a massive acceleration in it. Interestingly enough, the natural increase in Ireland slowed quite significantly, which doesn't get much attention, but the natural increase is now down to about 20,000. We've had a very significant decline in fertility rate in Ireland, birth rate, and the natural increase is quite low. So you've got this chronic excess chronic excess demand, in simple terms. The other thing that can affect housing, of course, is credit, and as I mentioned before, in a crash, banks collapsed, employment collapsed, housing collapsed, house prices collapsed. So in the last few years, we've had, this chart shows that the orange line is the increase in interest rate. So you might expect as interest rates went up, you would get a significant impact on lending, but the reality is you didn't. So this is it's a 12-month figure for mortgage approvals. And you can see it's still kind of over 40,000 as an annual figure. And as I said, a big factor there, I think, was simply the change in the LTI from the central bank, which allowed banks to lend a bit more. But essentially, in Ireland, to buy a house is only available to people on relatively high incomes. So the average annual wage in Ireland for full-time employment is a bit over 50,000. The data from mortgage lending shows that the average buyers their income is over 70,000, and largely joint purchases. So couples buying a house. So you need combined income, well above the average to buy a house. And interestingly enough, the loan to value has actually fallen slightly. That's around 80%, because people have a lot more money for a deposit. So we have this sort of chronic excess demand. Consequently, how do we get increased supply? And one of the fundamental issues with supply is funding. And this chart shows you the outstanding amount from Irish banks to real estate. And as you can see, there's been a significant fall in, all of them have come down. So you've got commercial, the biggest fall in recent years, residential and mixed. So quite clearly, so the stock of lending in recent years, last couple of years maybe, is not changing much to residential. So there is a flow every year, but there's certainly clearly here no significant change in the trend. So banks are not big lenders to in terms of residential construction. In fairness, they would argue, I presume, that, and again this is probably not well enough understood, that if a bank lends money to anybody, it has to put capital aside in case it's not repaid. And each loan is assigned a risk weight. And mortgage lending in Ireland, mortgage lending itself is a very high risk weight by international standards because of the legacy problems of huge defaults, but also because it takes almost 4 years in Ireland to repossess a home. So for cultural and political reasons, social reasons in Ireland, home repossession is not something that society particularly likes. But the flip side of that is you'll get, that pushes up the risk weighting on mortgage lending. And also, in terms of house building, exactly the same kind of issues. If you've had a lot of problems with builders historically, builders per se, but uncompleted developments and so on, and defaults, that legacy impact affects the bank's balance sheet, which doesn't affect non-banks, of course. So a huge amount of funding has been from non-banks, and that could be, domestic non-banks, that could be foreign non-banks, could be hedge funds, could be insurance companies or whatever. But the problem is, of course, that those tend to be demonized in the media and politically. So the kind of irony is the big driver of Irish housing supply, particularly a few years ago, were these foreign non-banks, and yet they're the ones that they're demonized. If they weren't there, there wouldn't have been the supply that was created. So housing obviously is a huge economic issue, a huge social issue, and therefore it is a huge political issue, as we know for a long time. So the problem, I suppose, in a lot of countries, including our own, is that there is a kind of pressure on government to be seen to be doing something about everything. But the problem is then you end up with a kind of knee-jerk scattergun reaction to everything. I mean, if you think about it, the government brought in a tax rebate for mortgage interest that went up in 2023. Now, people on tracker mortgages have had years where they were paying 1%. And yet, when it went up for a few years, they brought in a tax rebate because that was a problem. So the problem I think, if you look at the amount of money that the Exchequer, I was going to say throw at housing, provide for housing, it is big. Both in terms of the amount they spend directly and particularly all of the kind of subsidies that they provide. But the problem is pretty simple, and that is what you're largely doing is subsidizing buyers. And the Irish market is largely now a first-time buyer market. If you look at mortgage lending, like 75% of lending for house purchase is to first-time buyers. Those are the demographic, if you want to call it, that are key now, and that's what all government policy tends to be pushed towards. So you have Help to Buy. You reclaim 30,000 for tax paid over the previous 4 years. The government, that's cost the government 800 million. The problem with a lot of these as well is that there's no sunset clause. That was supposed to be a one-off that was going to be removed in December 2019. It's now extended to December 25. I know Sinn Féin have said if they get in, if they're in government, that they would abolish it. But A, I don't think they would be government at the minute, but B, that would be very difficult politically So the problem is, once you introduce these things, they're kind of locked into them. It's very difficult politically to get rid of them. So you have Help to Buy, you have a shared equity scheme, you have affordable housing scheme where the government takes equity stakes, all of which are obviously pushing up demand. The ESRI did a study of the first Help to Buy scheme, and said it's a huge chunk of people that are availing of it don't need it. They have the income to buy anyway, so they're just pushing up demand and pushing up prices. And there's a plethora of these things. And a lot of them are quite small. The local authority loan is a strange one, because that's for subprime borrowers. To avail of it, you have had to be turned down by 2 lenders. And the interest rate on it is lower than you would normally pay if you were a prime borrower. So it just illustrates the kind of pressure that develops and leads to these kind of issues. So how do you boost supply? And the answer is, the first thing you do is you don't put rent controls on. Every study shows, not every study, but the vast majority of studies of international experience from rent controls come to the same conclusion. They reduce the available supply of rented property, they reduce the total supply of housing, and they reduce the quality of rented property available. So we have rent controls of 2% right now. Interest rate is much higher than that for most people. And secondly, of course, over recent years, inflation has been much higher than that. So in terms of encouraging somebody to build a place to rent, to get an adequate rate of return, it's very difficult to see how that's going to be positive at all. And of course, one of the parts Sinn Féin is saying if we were in, we'd have zero rent controls. We'd have zero increase in rents for 3 years, I think they said. So you're back to the point that it's all kind of populist, short-term things, but it's not a sensible housing policy at all. I thought the government are doing a lot of other things on the supply side. I think one of the most interesting things was the increase in the use of the Land Development Agency, which of course the idea is can bring publicly owned land into the development area and build houses on it. But again, you're looking at very slow, bureaucratic, there's very little, there's no incentive for anybody to do anything in the public sector really. So you get long delays, a lot of inertia, a lot of departments that are not coordinated together. So that will help, but it's very difficult to see the state having a massive impact on the market. What I find odd is that the government will say, for example, right now, the target was 33,000 houses. But normally when you say, I have a target, Ten Hag might say, I have a target for winning the league this year. That is, to some degree, within his gift. If I say I'm going to build 33,000 houses, the government doesn't build any houses at all, really. Yes, the private sector builds most of them. The government can buy some of them, which they do, or hire construction companies to build their own. but they don't, it's not a target you can actually directly control. So it's hard to see, in other words, I think, a massive increase in housing supply. So to conclude, I think we're clearly looking at a massive chronic excess supply. And I think one of the interesting things, I'm sure you've all seen this recently, is you get a lot of people putting forward projections of how many houses we need. I'm not saying any of those are wrong, but why do they differ so much? And they differ so much there's three things basically that can affect it. The most crucial is what's the Irish population going to be in 20 years' time? Largely depends on your view or your forecast projection of net immigration. You can get a figure of over 7 million. You can get a figure of 5.7 million. Secondly, how many people are going to be living in each house? Ireland's, the number of people per house in Ireland is relatively high. It's 2.75. It hasn't changed because we don't build much houses. In England, it's around 2.1, 2.2. So again, when you're doing a projection, if you assume that if we build it, they will come kind of thing, people will move into houses, and it goes down to 2.2 over 25 years, that has a massive impact on your demand projection. But it's a bit circular, because obviously the reason number of people per house hasn't gone down much is because we haven't built many houses. They have to live with their parents. And the third one, which doesn't matter a great deal, is what although is very difficult to get out, doesn't matter to some degrees, the obsolescence of the existing housing stock. So that's why you can come up with 33,000, you can come up with 65,000. I think everyone would agree we don't build enough houses. Whether we need 65, 40, or is you can't possibly answer that in a sense. The other thing which I'm always a little bit puzzled about these projections is any model of the housing market, the main driver of supply, if you think about it, why do people build houses? Largely built, if they're largely built by the private sector, it's a big risk. There's a big time lag between, I'm going to build these 50 houses, planning, delays, uncertainty, what's going to be the case in 2 years' time. So there's an equation done there. What's the likely return? And the likely return obviously depends on certain things that you can control to some degree. But you have to have an assumption about where the price is going to be. So if house prices rise 10% a year, that's going to have a massively positive impact on housing supply. If house prices rise 2% a year, it's clearly going to have a big impact on housing supply. You never see that in any, almost as if they take house price for granted. And of course, the irony is that the more houses you will build, the less likely it's going to be rising at 10% per annum. As I said, the political imperative I've spoken about, particularly first-time buyers, problem with rent controls, which I don't think are going to go away. As I said, I think one positive is the LDA and perhaps a better coordination in terms of the public sector supply of housing. But it's hard to see that being a massive the driver of supply. And just finally, the issues in terms of supply, people will be very familiar with them. Planning takes usually a long time, a bit unpredictable. The cost of building, and I think the other very important thing is somebody will stand up today and say at a party meeting or a government thing, "Oh, our target is 50,000 houses." If we had an unemployment rate of 20%, you say, "Well, there's a lot of unemployed people to build those houses." If your unemployment rate is 4.3%, where is the excess labour to build those houses? Of course, the labour supply is gone up, largely through migration. But of course, to some degree, then, where do the migrants who are building the houses, if you like, live? In the houses that you're building. So there are all those constraints to me. So bottom line, we're too negative about it, but it depends if, I suppose, what you think is negative. But it's just, I think, difficult to see, given all these constraints, absent a big shock to employment. And you could, I think if you looked at, say, I mentioned the AI, Ireland is an AI stock, but clearly if there was a big shock to on the tech side, I think that would certainly affect Dublin rents particularly quite a lot. Absent that, employment growth continues. It's hard to see demand being a big constraint. So you're left with, what are the constraints on the supply side? Yes, the government can do certain things, are doing certain things to some degree to improve those, but it's hard to see that having the kind of impact that I think some of the projections would suggest. Okay, I'll stop there.